Hello and welcome to this live webinar on the exposure draft, regulatory assets and regulatory liabilities. I am Raghava Tirumala from the IASB technical staff, and I am joined here today by Tadeu Sendin, a member of the International Accounting Standards Board, and my colleague Mariela Isern from the IASB technical staff. Please note that any views expressed by us in this webinar are personal views and not necessarily the views of the IASB board or of the IFRS Foundation. Now, before we start, a few housekeeping items. You can download the slides we are presenting today from the event resources box that you see on your left side of the screen. If you have any questions, please ask using the question box on your screen. We will pause for questions at appropriate times during the presentation. A recording of this session and the slide deck will be posted on our website later. If you have not already accessed the exposure draft, you can download the exposure draft and the accompanying documents and supporting material like the snapshot using the links on the slide. I will now hand over to Mariela to take you through the webinar's agenda.
Thank you, Raghava. Thank you all for joining us today. We have an hour session. We will split the discussion into three broad areas. First, the problem the board is trying to solve and how the board proposes to solve it. Second, we'll provide an overview of the main proposals. And third, we'll go through the likely effects of the board's proposals. For the second part, Raghava and I will briefly talk about each main proposal, and we'll ask our board member, Tadeu, to share some insights about the proposal. Tadeu, before we get into the proposals in the exposure draft, could you please shed some light on what problem the board is trying to solve?
Yes, Mariela, thank you and hello everybody. Well, what is the problem? Entities to which the exposure draft applies are those that are subject to rate regulation that establish basically the amount and the charge timing. The amount is the compensation the entity is entitled to charge customers for the goods or services supplied, and timing is when, that is, in which period that compensation can be included in the rates or price charged. The exposure draft calls this compensation as total allowed compensation and defines it as the full amount of compensation for goods or services supplied that a regulatory agreement entitles an entity to charge customers through the regulated rates in either the period when the entity supplies those goods or services or in a different period. Normally, this compensation for goods or services is charged to customers through the rates for the period in which an entity supplies those goods or services. But in some cases, there is a difference in timing. The regulatory agreement requires the entity to include in the rate some of that compensation for goods or services supplied in a different period. The problem is that IFRS 15, revenue from contact with customers, follows the regulated rate. It does not consider this timing difference, and therefore the amount of revenue the entity recognized in the period applying IFRS 15, when there is a timing difference, will include compensation for goods or services supplied in the past, or will be supplied in the future, or does not include all the compensation that the entity is entitled for the goods or services supplied in the period, because part of this compensation was already included in rates charged in the past, or will be included in rates to be charged in the future. Let me give you an example to better explain it. Let's assume the regulated rate an entity charged for goods supplied in year 1 is based on estimated input costs of 100, but the entity actually incurs input costs of 120. Let's also assume that the regulatory agreement gives the entity the right to add the under-recovery 20 of those input costs in the rates to be charged to customers in year 2. Applying IFRS standards, for year 1, the entity recognizes revenue of 100 and the actual input cost of 120. The entity is, however, entitled to compensation of 120 for the goods supplied in year 1. And then, in year 2, the regulated rate the entity charges for goods supplied is based on the estimated input cost of 100 for year 2, plus the under-recover of 20 of compensation of year 1. Therefore, the amount of revenue the entity recognizes in year 2 will reflect compensation of 120. However, the compensation of 20 included in revenue of year 2 is part of the compensation for goods supplied in year 1. This example illustrates that without information about the timing difference of 20, investors would not understand that revenue in year 1 does not include compensation of 20 for goods supplied that year, and revenue in year 2 includes compensation of 20 that relates to goods supplied in year 1. And this is the problem we want to address with this proposed standard. When there are differences in timing, the IFRS financial statements do not provide sufficient information for users to understand completely the relationship between revenue and expenses, for example, the operating profit. It makes more difficult for users to understand what portion of a fluctuation in the revenue-expense relationship is because a matter of performance or whether this is because of timing difference or a mix of those. In our example, just looking at the revenue line, users would not know that the increase in revenue from year 1 to year 2 of 20 is only because of difference in timing. Even if the users are able to obtain information about difference in timing, for example, in the notes or from other sources, they still need to make adjustments in their cash flow projections. And how to sort this out? This is what we will explain the next few slides, how to sort this out, how to solve this problem, or how the board is proposing to solve the problem. In this slide, difference in time are associated with rights to increase or obligation to decrease future regulated rates. If a regulatory agreement requires part of the compensation for goods or services already supplied to be included in future regulated rates, that difference in timing is associated with a regulatory asset. If the regulatory agreement includes in the regulated rates charged compensation for goods or services to be supplied in the future, that difference in time represents a regulatory liability. It is like receiving in advance part of the revenue related to goods or services that will be provided in the future. We will explain the definition in some more details later in this webinar. But a key point for this proposal is that the board also concluded that regulatory assets and regulatory liabilities meet the definition of an asset and a liability in the conceptual framework for financial reporting. The problem of insufficient information about differences in timing that we discussed in the previous slides can be solved by an entity recognizing regulatory assets and regulatory liabilities in its statements of financial position and regulatory income or regulatory expense in the statement of financial performance. The effect of recognizing regulatory assets and regulatory liabilities is that when the entity reports financial performance for a period, it would reflect the total allowed compensation, the compensation to which the entity is entitled for goods or services supplied in that period. To explain better, let's go back to our example and see what the entity would do when applying the proposals. In year one, the entity would report regulatory income of 20 to reflect the compensation for goods supplied in year one that is not included in the rates of the year, and report a regulatory asset of 20 to reflect the right to add the amount in setting the rates for year two. And in year two, the entity would report regulatory expense of 20 to reflect the fact that rates charged in year two, and hence the revenue for that year, includes compensation for goods supplied in year one. With that, it would realize the regulatory asset to reflect recovery of the amount of 20. With this information provided in the financial statements, the users would have sufficient basis to understand completely the relationship between expenses and revenue, and also to understand how much of the increase or decrease in revenue from one period to another is because of difference in timing. With all the information that users would have once the proposals are applied, they don't have to worry about making adjustments for difference in time when making future cash flow projections. A word of caution. We are not saying that all information about differences in timing would be available in the financial statements. What we are saying is that the financial statements prepared applying the proposals would provide a good basis for users to understand the effects of differences in timing. I will now hand over to Raghav and Mariela to take you through the main proposals in the exposure draft.
Thank you, Tadeu. Let's first see the scope proposals. The exposure draft simply says that an entity shall apply the proposals to all its regulatory assets and regulatory liabilities. It then points out that regulatory assets and regulatory liabilities, as defined in the exposure draft, exist only if three conditions are met. First, the entity has to be a party to a regulatory agreement. A regulatory agreement is defined as a set of enforceable rights and obligations. The regulatory agreement need not always be titled as a regulatory agreement. It can be a licensing agreement or a service concession agreement or a statute or a legislation or regulation. Whatever it is titled as or whatever form it takes, what is important or what is required is that the entity has a legally enforceable right and obligation. Second, the regulatory agreement establishes the basis for how the entity must set the regulated rates charged to customers. Third and last, the regulatory agreement creates differences in timing, thereby creating regulatory assets and regulatory liabilities. If any of those conditions are not met, the proposals in the exposure draft would not lead to an entity recognizing regulatory assets or regulatory liabilities. Now, for example, if the regulatory agreement simply establishes a cap price, that is, a maximum price that an entity can charge its customers, such regulatory agreement would not create regulatory assets or regulatory liabilities if the right to charge up to the cap price is not linked to goods or services already supplied, and the obligation not to charge above a cap price is not linked to consideration already received. So, Tadeu, when someone imagines a financial reporting standard that requires reporting the effects of rate regulation, they would expect that the scope section of the standard would specify features of the entities to which the standard applies. Now, why the expectation? That's because not all entities are subject to rate regulation, right? However, the exposure draft specifies only 3 features that must be present for regulatory assets or regulatory liabilities to exist. For example, the exposure draft does not specify what the objective of the rate regulation should be, or that aspects of the entity's activities other than rate setting should be regulated, or that there should be a regulator with specified characteristics. Now, what were the board's considerations?
Well, this is a good question, Raghava. The board tried to develop clear-cut definitions for a regulatory asset and a regulatory liability. When developing the definitions, the board observed that in addition to the three conditions you see on your slide, there was no reason to include other features because those features need not to be presented for a regulatory asset or a regulatory liability to exist. We believe that requiring the presence of those other features would not result in a distinction that produces information more useful to users of financial statements. If the exposure draft were to specify all those other features, that would limit the proposed scope of the model to cover only a subset of entities that have regulatory assets and regulatory liabilities.
Thank you, Tadeu. Now, the next question is, but why only regulatory assets and regulatory liabilities? Why not require reporting the broader effects of rate regulation?
A regulatory agreement tends to be a much more broader document with many rights and obligations on it. The proposals specify only how to account for regulatory assets and regulatory liabilities, which are a subset of all rights and obligations created by a regulatory agreement. And just to remind you that an entity would apply other IFRS standards when accounting for the effects of all other rights and obligations created by a regulatory agreement. Just to give you an example, an entity typically does not recognize as an asset its rights to supply goods or services in the future or to increase its price in the future, or a liability as obligation to supply goods or services in the future or to decrease its price in the future. The point is that the proposal would not affect the information an entity provides about the effects of those other rights and obligations.
Thank you, Tadeu. We have a question. So every company has statutes of incorporation, such as the Articles of Association, which include written rules and policies about running the company, sort of a self-regulation. Now, these rules or policies may prescribe how the company should set prices for its goods or services. Would anything coming out from the company's own statutes meet the definitions of regulatory asset or regulatory liability?
The short answer is no. An entity cannot create enforceable rights and obligations with itself, and therefore those internal statutes cannot create regulatory assets or regulatory liabilities.
Thank you, Tadeu. So let's move on with the remaining scope proposals. So I will now talk about a regulatory asset and a regulatory liability in some more detail. An entity has a regulatory asset when total allowed compensation for the goods or services supplied in a period has not been fully included in the regulated rates charged during that period, and consequently has not been fully included in the revenue recognized during that same period. As a result, the entity has an enforceable present right to add that unrecovered part of compensation for goods or services supplied to the future rates the entity will charge customers. Now, the entity would report that right as a regulatory asset and corresponding regulatory income. In a future period, that you see on the right side of the slide, when the entity charges customers a rate that includes the part of the total allowed compensation for goods or services supplied in previous periods, the entity would recognize revenue and would reflect the recovery of the regulatory asset by de-recognizing the regulatory asset and accounting for regulatory expense in the statement of financial performance. Therefore, a regulatory asset is defined in the exposure draft as an enforceable present right created by a regulatory agreement to add an amount in determining a regulated rate to be charged to customers in future periods, because part of the total allowed compensation for goods or services already supplied will be included in revenue in the future. Now, let's see what a regulatory liability is. A regulatory liability arises when the regulated rates charged in a period and hence revenue recognized in that period include compensation for goods or services the entity will supply in the future. For example, an entity may be entitled to add in the rates charged in the current period an amount that pre-funds part of the total allowed compensation for goods or services to be supplied in the future. That creates an enforceable present obligation for the entity to deduct the compensation already recovered from the rates the entity will charge customers in the future. So an entity reports that obligation, to deduct the rates in the future, as a regulatory liability and a corresponding regulatory expense. In a future period that you see on the right side of the slide, the entity fulfills the regulatory liability when it deducts the compensation already recovered from the rates it charges customers. This means that in a future period, the entity recognizes a lower amount of revenue than that it would have recognized had it not recovered compensation in advance. The entity reflects the fulfillment of the regulatory liability in the future period by derecognizing it and accounting for related regulatory income in the statement of financial performance. Therefore, a regulatory liability is defined in the exposure draft as an enforceable present obligation created by a regulatory agreement to deduct an amount in determining a regulated rate to be charged to customers in future periods, because the revenue already recognized includes an amount that will provide part of the total allowed compensation for goods or services to be supplied in the future. So Tadev, there are two questions that we are very likely to be asked. First, would it be always easy to conclude whether regulatory assets or regulatory liabilities exist?
During the project, Raghava, the board learned that the terms of regulatory agreements are typically clear enough that there will be little uncertainty about whether regulatory assets or regulatory liabilities exist. But in some cases, for example, when items have not been formally approved by the regulator before the entity finalizes its financial statements, judgment may be needed to interpret the terms and conditions of the regulatory agreement. In such cases, entities may need to consider other evidence, such as regulatory decisions or court rulings, or the entity's experience with regulators' interpretation of the regulatory agreement in similar circumstances. Actually, the exposure draft includes a list, it's not a non-exhaustive list of evidence to consider.
Thank you, Tadev. Another question is, what distinguishes a regulatory asset from a general right to increase future prices?
That's a very important distinction that our stakeholders need to understand. A regulatory asset is not a general right to increase future prices by any amount at any time for any reason. A regulatory asset permits an entity to increase future regulated rates only by a fixed or determinable amount and only because of goods or services already supplied. An entity that is not subject to rate regulation typically has a general right to increase future prices by any amount at any time. Although less constrained than a regulatory asset, that right is typically available to all parts without significant cost. The conceptual framework explains that rights available to all parts without significant costs are typically not assets for the entities that hold them. For example, rights of access to public goods, such as public rights of way over land or know-how in the public domain, these are generic assets, not assets for the entities themselves.
Thank you, Tadeu. Mariela, over to you for the next set of proposals.
Thank you, Raghav. I will now take you through the concept of total allowed compensation for goods and services, which is at the heart of the proposals. Tadeu has already introduced the concept of total allowed compensation for goods and services. The exposure draft identifies three components of total allowed compensation. First, compensation for expenses that the entity incurs when supplying goods or services and that a regulatory agreement entitles the entity to recover. The exposure draft refers to such expenses as allowable expenses. In some other cases, an entity will be required by the regulatory agreement to pass through to customers amounts of income that the entity has earned on a specific transaction, for example, gains on the sale of an asset. The exposure draft refers to such income as chargeable income. The second component of total allowed compensation is target profit, which are amounts that represent profit mainly in the form of regulatory returns on amounts invested in the assets that the entity uses to supply the goods or services, or in the form of performance incentives, bonuses, or penalties. The third component is regulatory interest income or regulatory interest expense, which I will talk about in the next slide. I will also explain why it is shaded in a different color. So, what is the guidance that the exposure draft provides for each of the components of total allowed compensation? For each of the components of total allowed compensation, the exposure draft provides guidance to help an entity determine whether that component relates to goods and services supplied, for example, in the current period, or whether it relates to goods or services supplied in a different period. The answer to that question would determine the period in which that component would be reflected in the statement of financial performance, regardless of when that component has been included in the rates charged to customers. Let us first start with amounts to recover allowable expenses less chargeable income. An entity would reflect compensation for allowable expenses less chargeable income in financial performance in the same period in which the entity reports the expense or income by applying IFRS standards. In our earlier example, the input costs were an expense that the entity could recover in full through the rates. They were an allowable expense. The entity recognized input costs for an amount of 120 in year one. Therefore, the compensation of 120 forms part of the total allowed compensation for the goods or services supplied in year one, regardless of when the amount of 120 is included in the rates charge. Moving to regulatory returns. The exposure draft establishes that regulatory returns that a regulatory agreement entitles an entity to add in the rates charged in a period form part of the total allowed compensation for the goods or services supplied in that same period. This means that the regulatory returns that an entity is entitled to add in the rates in a period would be reflected in profit in the same period. For one case only, the board concluded that returns to which a regulatory agreement entitles an entity to add in the rates in a period should form part of total allowed compensation for the goods or services supplied in a different period. And these cases when an entity is entitled to include in the rates charged in a period returns on an asset that is not yet available for use because, for example, it is being constructed. The entity would be including those returns in the rates it would be charging when supplying goods or services to customers in that period using other assets. In this case, the exposure draft proposes that any returns on an asset that is not yet available for use charged during the construction period form part of the total allowed compensation for the goods or services supplied not during the construction period, but once the asset is available for use. The board concluded this way because during the construction period, the entity is not yet supplying goods or services with that asset. Moving on to performance incentives. A regulatory agreement might incentivize an entity to achieve specific performance criteria. For example, targeted levels of service quality, reliability, or customer satisfaction. Compensation in the form of a bonus or lower compensation in the form of a penalty would form part of total allowed compensation for the goods or services supplied in the period in which an entity provides the performance that gives rise to the incentive, regardless of when that incentive is included in the rates. Lastly, regulatory interest income or regulatory interest expense. A regulatory agreement might compensate an entity for the time lag between the origination of a regulatory asset and its recovery, or might charge the entity for the time lag between the origination of a regulatory liability and its fulfillment. In that case, the entity would report regulatory interest income on a regulatory asset or regulatory interest expense on a regulatory liability as interest accrues throughout the life of the regulatory asset or regulatory liability. The reason you see regulatory interest income or regulatory interest expense in a different color is that this component of total allowed compensation is the only one created by a difference in timing, with its amount being incremental and depending on the time lag. The amounts of all the other components are not affected by the time lag. They might be included in the rates in the same period when the related goods or services are supplied, or in a different period, but their amount will not change. So, Tadeo, rate-regulated entities might not yet know the term total allowed compensation for goods or services, but some of them might be familiar with the term revenue requirement. How could those entities understand the difference?
Good question, Mariela. Let's start first with the term revenue requirement. Revenue requirement is typically the amount that an entity is entitled to include in determining regulated rates for goods or services to be supplied in a specified period. We may also heard the term authorized revenue or allowable revenue instead of revenue requirement. In contrast, the total allowed compensation is the full amount of compensation for the goods or services supplied in that period, regardless of whether that compensation is included in the, let's say, revenue requirement in the same period or a different period. From what we explained before, you know that there are differences in timing if the revenue requirement for the period includes part of the total allowed compensation for goods or services that were supplied in previous periods or that will be supplied in the future periods. The difference in timing also exists if the revenue requirement for a period does not include part of the total allowed compensation for goods or services supplied in that period. Just to give you an example, when a difference in timing occurs, the revenue requirement for a period would not equal the total allowed compensation for goods or services supplied in that same period, is when an amount was included in the revenue requirement for the current period, but was under or over recovered because of volume variance.
Thank you, Tadeu. We now move to the measurement proposals. The measurement of regulatory assets and regulatory liabilities is based on cash flows. Throughout this project, we have learned that cash flows arising from regulatory assets or regulatory liabilities are typically fairly stable and predictable. However, in some cases, they might be subject to some uncertainty because of demand or credit risk. In those cases, an entity would estimate future cash flows using either the most likely amount method or the expected value method, depending on which method the entity concludes would better predict those cash flows. Also, the exposure draft proposes an entity updates its estimates of future cash flows if changes occur. The EV also involves discounting all of the cash flows arising from a regulatory asset or regulatory liability, including those related to regulatory interest, and in most cases, using the regulatory interest rate as the discount rate. The exposure draft proposes that the discount rate established at initial recognition would be kept unchanged unless the regulatory agreement changes the regulatory interest rate. So, Tadeu, would all regulatory assets and regulatory liabilities be measured using the cash flow-based measurement technique we just described?
No. Actually, in some cases, a regulatory agreement treats an item of expense or income as allowable or chargeable in determining the regulated rates. Only once an entity pays or receives the related cash, instead of when the entity recognizes that item as expense or income in its financial statements. I think that's better if I give an example. For example, pension costs. The regulatory agreement may specify that they are recovered only when contributions are paid in cash. For those regulatory assets and regulatory liabilities, the exposure draft proposed that an entity measures them using the same measurement basis used in measuring the related liability or related asset by applying IFRS standards. That is because cash flows arising from those regulatory assets or regulatory liabilities are a replica of the cash flows arising from the related liabilities or assets.
Thank you, Tadeu. Moving now to the proposals on discount rate. As I have just mentioned, the exposure draft proposes that an entity uses the regulatory interest rate provided by the regulatory agreement as the discount rate, and that it recognizes regulatory interest income or regulatory interest expense as the discount unwinds over time. There is only one case when an entity would not use the regulatory interest rate as the discount rate, and this is when the regulatory interest rate for a regulatory asset is insufficient. When there is an indication the regulatory interest rate provided for a regulatory asset might not compensate an entity for the time value of money and uncertainty in the cash flows, the entity would be required to estimate the minimum interest rate that would provide such compensation and use that rate for discounting if that minimum interest rate is higher than the regulatory interest rate. So, Tadeu, would you expect discounting to be complex?
That's a good question, Mariela. The board cautiously tried to keep discounting proposals simple in most cases, the regulatory interest rate provided in the regulatory agreement would also be the discount rate required by the proposals. In such cases, the simplest way to determine the present value of the future cash flows at initial recognition would be to sum the future cash flows, excluding the cash flows that result from regulatory interest. This would also hold for subsequent measurement if the regulatory interest rate is also the discount rate, and the regulatory interest is recovered or fulfilled in the same period in which it accrues. Only in the case of regulatory assets, an entity has to do the sufficiency test as you explained earlier. Having said that, because rates are typically designed to support financial viability, cases in which the regulatory interest rate is insufficient are expected to occur not often.
Thank you, Tadeu. I will now turn to Raghava to take us through the presentation and disclosure proposals.
Thank you, Mariela. So moving on to the presentation proposals. The exposure draft proposes that regulatory assets and regulatory liabilities should be presented in separate line items in the statement of financial position. If an entity presents a classified balance sheet, it would present current regulatory assets, non-current regulatory assets, current regulatory liabilities, and non-current regulatory liabilities as separate line items in the balance sheet. All regulatory income minus all regulatory expense, which is the net movement between opening and closing balances of regulatory assets and regulatory liabilities, is presented as a separate line item immediately below revenue. Now, this slide illustrates the presentation in the statement of profit or loss. I mean, it's in a way a repetition of some of the content on one of the earlier slides. So the only point I would add here is that the exposure draft proposes a requirement to disclose a breakdown of the regulatory income minus regulatory expense line item, which we'll discuss shortly. So today, why did the board propose presenting regulatory income minus regulatory expense in a line item immediately below revenue?
Raghava, our aim was to make the presentation proposals simple and intuitive. Regulatory income, regulatory expense are not themselves revenue. Regulatory expense includes items that affected revenue in the current period, that is, recovery of regulatory assets and initial recognition of regulatory liabilities. And regulatory income includes items that will affect revenue in the future, that is, initial recognition of regulatory assets and fulfillment of regulatory liabilities. With that, the board expects that presenting regulatory income minus regulatory expense as a separate line item immediately below revenue would provide users of financial statements with the clearest picture of effects of regulatory assets and regulatory liabilities on the revenue line item.
Thank you, Tadeu. So turning to the disclosure proposals, the overall disclosure objective proposed by the board is aligned with the objective of the exposure draft, and it focuses on providing more useful information about financial performance. An entity would be required to disclose in the notes information about regulatory income and regulatory expense, which, together with the information provided by applying other IFRS standards, would enable users of financial statements to understand the relationship between the entity's revenue and its expenses as completely as they can when all of the total allowed compensation for the goods or services supplied in a period is included in the regulated rates in that period. In other words, users of financial statements would be able to understand the revenue expense relationship as completely as they can when no regulatory assets or regulatory liabilities exist. Now, that understanding would provide them insights into the entity's prospects for future cash flows. The board also proposes a second disclosure objective, which is to provide information to enable users understand the entity's regulatory assets and regulatory liabilities. Now, that understanding will provide them with insights into how regulatory assets and regulatory liabilities affect the entity's future cash flows. Tadeu, why does the disclosure objective focus on effects of just regulatory assets and regulatory liabilities only and not the broader effects of rate regulation? The board could have proposed entities to report regulatory assets and regulatory liabilities, but the disclosures could be much broader. So why didn't the board do that?
The disclosure objective proposed in the exposure draft is more targeted than the disclosure objective of IFRS 14. An entity would disclose information to enable users to understand the effects of regulatory assets and regulatory liabilities only, and not the wider effects of rate regulations. Although information about the nature and risks associated with the rate regulation is useful to users, they do not rely on financial statements to provide that information. IFRS standards do not require users to disclose such information about any other form of regulation, and the board sees no reason to require entities to provide such information for rate regulation. As I said before, the conceptual framework states that users of financial statements need to consider pertinent information from other sources, for example, general economic conditions and expectations, political events and political climate, and industry and company outlooks.
Thanks, Dev. Now, turning to the proposed disclosure requirements, an entity would be required to disclose a breakdown of the amount presented in the line item regulatory income minus regulatory expense. As a reminder, that line item would be presented immediately below revenue in the statement of profit or loss. I will talk about it in the next slide. Now, the other disclosure requirements or the proposed requirements, an entity would disclose quantitative information using time bands about when it expects to recover the regulatory assets and fulfill the regulatory liabilities. It would also disclose an explanation of how risks and uncertainties affect the recovery of regulatory assets or fulfillment of regulatory liabilities. Now, the exposure draft also proposes that an entity should disclose information about discount rates used in measuring regulatory assets and regulatory liabilities. And finally, an entity should disclose a reconciliation from the opening to the closing balances of regulatory assets and regulatory liabilities to enable users of financial statements to understand if the change from opening to closing balances is for reasons other than regulatory income or regulatory expense. For example, changes because of business combinations or disposals of operations. Now, turning to the specific disclosure proposal of breakdown of regulatory income minus regulatory expense. The board proposes this requirement to enable users to understand the components and causes of regulatory income and regulatory expense. Going back to the very simple example that Tadeu discussed previously, the regulatory income of 20 in year 1 consists fully of additions of regulatory assets. The regulatory expense of 20 in year 2 consists fully of recovery of the regulatory asset. Now, in other situations, some of the other components and causes of regulatory income or regulatory expense would include additions of regulatory liabilities, fulfillment of regulatory liabilities, regulatory interest income or regulatory interest expense that we ignored in the simple example we discussed. Other items affecting measurement of regulatory assets or regulatory liabilities, such as changes in estimates of future cash flows. With that, I'll now hand over to Mariela for the transition proposals.
Thank you, Raghava. An entity would apply the proposals retrospectively on transition. This means that all comparative information presented in the first financial statements prepared applying the proposals would have to be restated. A full retrospective application is more useful to users than other approaches because it would make data comparable across time periods and across entities. The board also proposes an optional simpler approach, an optional modified retrospective approach for regulatory assets and regulatory liabilities that were acquired or assumed in a past business combination, but continue to exist on the date of transition. I will now hand over to Tadeu for him to explain the board's assessment on the likely effects of the proposals.
Thank you, Mariela. In relation to the likely effects of the proposals, they are not expected to affect all entities with regulatory assets and regulatory liabilities in the same way. The effects of the proposal on an entity's financial statements and the cost for implementing the proposals would depend on various factors. For example, whether entities are currently recognizing regulatory balances or how closely aligned the regulatory requirements are with the proposed measurement proposals. This slide summarizes, This slide summarizes the main idea behind the proposals: better information to users. It has many effects on quality of financial reporting, which we have explained at various points in this webinar. Presenting all regulatory income minus all regulatory expense immediately below revenue would make it easier for users of financial statements to understand the effects of regulatory assets and regulatory liabilities. Users would have a more complete understanding of the relationship between an entity's revenue and expenses in a period and over time. The information produced by the proposals would be more useful than the information currently provided by some entities reporting regulatory balances, because the focus of the proposals is on the future cash flows that result from regulatory assets and regulatory liabilities, rather than on the items of expense or income to which the differences in timing relates. Because all entities with regulatory assets and regulatory liabilities would apply the same principles, the financial information across entities would be comparable. The proposals would likely reduce costs incurred by users of financial statements for gathering information about differences in timing from other users. Well, now that we have covered the proposals in the exposure draft, let's talk about the next steps. We issued the exposure draft in January with a 150-day comment period. The deadline for sending your comments is 30 June. We will be conducting outreach events during the comment period, and the board will discuss the feedback from the comment letters and the outreach events thereafter. We are looking forward to your comments. And now, I think that we still have time for some questions. Let's see what else we got from the audience. Agava, Mariela, would you like to pick one?
Okay, so yes, here there is a question. Would regulatory assets be tested for impairment? Well, the answer is no. The exposure draft does not include a separate impairment test for regulatory assets, but it includes two proposals that ensure the measurement of regulatory assets is appropriate. First, the ED proposes that an entity updates the estimates of future cash flows arising from a regulatory asset if changes have occurred. So, for example, we know that demand risk or credit risk are factors that can change the cash flows. And if so, then those cash flows would need to be updated. And second, The ED proposes that an entity assesses the sufficiency of the regulatory interest rate provided for a regulatory asset on initial recognition and subsequently if the regulatory agreement changes the regulatory interest rate, and that the entity uses the minimum interest rate as a discount rate if that rate is higher than the regulatory interest rate. So those two proposals make a separate impairment test to be unnecessary.
Thank you, Mariela. There is one question here that I myself, when I was discussing this project, I asked the project team, and now, of course, I understand that one. Can a service concession arrangement that is within the scope of IFRIC 12 create regulatory assets and regulatory liabilities? That's definitely a very good and fair question. We suppose that all service concession arrangements within the scope of IFRIC 12 are subject to some form of rate regulation, because the grantor regulates the price to be charged for the services. And then, therefore, it's likely that we say that it is within the scope. And then, applying IFRIC 12, entities may apply the intangible asset model, the financial asset model, or a kind of hybrid model, depending on the facts and circumstances. When an entity applies the intangible asset model, some of those arrangements may create regulatory assets or regulatory liabilities within the scope of the exposure draft based on our experience and conversation with our stakeholders. It, of course, depends on the terms and other facts and circumstances. And then in this case, an entity would apply IFRIC 12 in accounting for all other assets and liabilities created by the arrangement. But when we look at the companies applying the financial asset model, those arrangements do not create regulatory assets or regulatory liabilities, because any rights that could give rise to future cash flows supposed to be already recognized as part of this, the financial asset. Hagava, would you like to pick one question?
Yeah, Tadeu. So I think there's a question on unit of account. So would a company have to account for each regulatory asset and each regulatory liability separately? Now, the exposure draft proposes that the unit of account is a right or obligation associated with each individual difference in timing. Having said that, if rights and obligations arising from the same regulatory agreement have similar expiry patterns and are subject to similar risks, they may be treated as arising from the same individual difference in timing.
Okay. I'm taking the ones that if I were in the audience, I would make. I like this one. What sectors do you think will be affected by the exposure draft? That's difficult to generalize. When we were developing the exposure draft, we became aware that utilities, especially electricity, gas, water, are most likely to be affected. But it doesn't mean that utilities all over the world would be affected similarly. It depends on whether the regulation creates rights that are regulatory assets and obligations that are regulatory liabilities. We need to understand what are the content of the regulatory agreements to conclude whether it is or not affected by the proposal. And also in the process of developing the proposal, we learned that other sectors, such as public transport, telecom, postal service, we have many discussions with many stakeholders about that, that in some cases might also be affected. In summary, it all depends on facts and circumstances to conclude whether it is in the scope or not of the exposure draft.
Tadeu, there's one question I would like to probably pick up. I mean, there were a few questions on interaction with IFRS 15. And I think some of them even asked why not incorporate the requirements into IFRS 15. Can I take that question?
Yes, of course. Go ahead.
Yeah.
We are about to finish the end of our time, but yes, we still have time.
Yeah. So, I mean, just to explain, I think the board did consider in the past if there can be modifications made to IFRS 15 rather than having a separate standard. But I think one of the difficulties is to reconcile the focus of IFRS 15, which is on individual contracts with customers and not with the customer base as a whole. Now, that was one of the reasons. Now, the other reasons are a regulatory asset or a regulatory liability is created by a regulatory agreement and not by contracts between company and its customers. So when a company has a regulatory asset or a regulatory liability, the customers would pay the higher or lower rates in the future would not necessarily be the same as the existing and the past customers to whom goods or services were supplied or to whom the amounts were charged. So it's broadly for these reasons that it probably didn't make sense to incorporate these requirements into IFRS 15, or it would have been difficult to just merge these requirements into IFRS 15.
Okay, very good. Thank you very much. There is one question here that's interesting. People asking what's the difference between regulatory asset and regulatory asset. I would say that just a matter of accent. But anyway, we have come to the end of the webinar. Thank you all for joining us, and don't forget to send your comment letters. Have a great day, and thank you very much.